Types of funds. Our learning objectives for this session include reviewing the different categories of funds and the different types of funds in each category. This includes equity funds, income funds, money market funds, blended funds, foreign funds, and ETFs, or exchange traded funds. When we're looking at equity funds, these are funds that primarily invest in stock. Our first fund is a growth fund. This fund invests in growth common stock. It doesn't pay a lot in dividends. This is for younger investors who can assume some risk. This is for an investor who doesn't really care about getting a dividend. Instead, they care about capital appreciation. That's their goal. They want to buy their share at $5 and eventually sell it for $105. An aggressive growth mutual fund is also for younger investors. But now our investor can even assume a greater amount of risk than that of a growth fund. So an aggressive growth fund will invest in smaller or newer companies that have no track record of success, and if they do have a track record, it's a very small one, based on performance. Capital appreciation is the goal. With a blue chip fund, this is the best of the best. Google, Microsoft, they invest in companies that customers know. They invest in blue chip stocks, things that trade on the big board or the New York Stock Exchange. These are for younger investors who want to invest in a group of products that they know. Finally, here is an equity income fund. These funds invest in dividend-producing stocks. That includes income, common stock, and preferred stock for its consistent dividend, along with growth. A sector-specific fund is more aggressive than even an aggressive equity fund because usually we're only in one market segment and laws can change. So that is legislative risk, the risk that laws can change, primarily tax laws. So sector-specific is known for its sophisticated investor who understands the type of risk that they're getting into. Lastly here are index funds. They invest in stocks that mirror a specific index, like the S&P 500 index. Index funds are passively managed and have lower ongoing costs when compared to other actively managed funds. Now let's take a look at our income funds, or our funds that invest in debt instruments. A U.S. government fund will invest in direct obligations of the United States government, including Treasury bills, Treasury notes, and Treasury bonds, as well as Treasury strips and TIPS. These are usually used for older investors who want a consistent income with a higher degree of safety. Remember, our U.S. government debt instruments carry the highest degree of safety when compared to municipal and corporate bonds and U.S. governments because it's the taxing power of the United States government that backs the debt. A Ginnie Mae fund or Ginnie Mae debt invests in pass-through certificates, and these are pools of mortgages. An older investor wants to have a higher degree of safety with current monthly income. That's the key word, monthly. That's the investor for a Ginnie Mae fund. It's the only fund that will automatically pay out monthly income to investors because people pay their mortgages monthly. A municipal bond fund is for wealthy investors, and it invests in municipal bonds, both GO and revenue bonds. For an investor in a municipal bond fund, they'll get diversification plus tax-free interest income on the federal level. These are for wealthy investors who want diversification and tax-free income. Finally here, we have corporate bond funds. They invest in corporate debt. So we have investment-grade corporate bond funds, which invest in high-quality corporate bonds. And then we have high-yield corporate bond funds that invest in junk bonds. They invest in the aggressive bonds. So corporate bond fund is for an older investor, although for someone that's willing to take a little bit more risk for a higher income payout. Next, we take a look at money market funds. A traditional money market fund is for somebody seeking capital preservation and or liquidity. They need the money very soon. So usually they're investing for 2 years or less, sometimes a year or less. Money market instruments will invest in T-bills, commercial paper, maximum maturity of 270 days, and negotiable CDs with a maximum maturity of 270 days. If it's a wealthy investor, which means they're successful like a doctor or a lawyer, or you find out that they're in a 28% or higher tax bracket, and they're looking for capital preservation or liquidity, then you'd put them into a tax-free money market fund. These invest in short-term municipal debt that will give the investor tax-exempt income off of their money market fund. Then we have our blended or our growth and income funds. A balanced fund will always attempt to retain the same percentage in different types of securities. For example, if you have a balanced fund that's invested in stocks and bond, 50% is invested in stock and 50% is invested in bonds. At the end of every year, the portfolio manager, the investment advisor, will go in and make sure that the portfolio is rebalanced back to 50-50 at the beginning of the new year. An asset allocation fund is considered to be the best diversifiable fund. It'll invest in stocks, bonds, and money market instruments. But unlike the balanced fund, it doesn't have any fixed amount. So with asset allocation funds, I always tell students, use the investor's age for their bond allocation in the portfolio. So for example, my friend Jesus is only 20 years old. How do we break up his asset allocation? Well, his age is 20, so the debt percentage should be around 20%, and the other 80% should be in equities. Then we have our target date fund. This is a type of asset allocation fund that we see used a lot in retirement accounts. So for example, a target date of 2035. Maybe it's a target date fund I invest in, and while I'm younger, the portfolio is higher rated in equity securities. Then after a certain year, they'll shift and they'll start rechanging that portfolio so that the time I retire in, let's say, 2035, the portfolio has changed to be more in debt than in equities. So while I'm younger, let's say 80% in equities and 20% in debt, if I were Jesus, then by the time I retire, it's 80% in debt and 20% equities. It shifts. I don't have to do anything as the investor. I always talk about a target date fund or a life cycle fund as a lazy person's way to save for retirement, because you don't have to worry about switching the fund once you become a little bit less aggressive, right? The portfolio does it for us. Then we want to talk about foreign funds. A foreign fund will invest primarily outside the United States. So with an international fund, they will invest in common stock outside of the United States. So anytime we're investing outside of the United States, we'll have both currency and political risk. Currency risk is also known as exchange rate risk or foreign exchange risk, and this is the inverse relationship between the US currency and foreign currency. So if the foreign currency is going up in relation to the pair, the US dollar is going down and vice versa. Political risk is anytime we're investing outside of the United States, how the politics in that country can affect our investing. So those are international funds that invest in common stock only outside of the United States. You guys, it's really important to remember that, because they do not invest at all inside the United States in anything domestic, only outside the US. If somebody talks to you about a global fund, global funds invest both in the United States and outside of the United States in order to look at a global economy. So they're, out of all of these three, probably the least aggressive, only because they can invest in the United States if they need to. And finally, we look at our country regional funds. These are also referred to as geographical or single country funds. They invest in stocks in small countries, or even potentially third world countries. So out of all three of these, country regional funds carry the most risk. Lastly, we want to talk about an exchange-traded fund, or an ETF. This is a crazy fund because it's classified legally as an open-end fund, so you can buy shares continuously from the fund's portfolio, and it trades like a closed-end fund or a stock in the secondary market, so it trades over an exchange. Most of our exchange-traded funds are passively managed index funds. The most popular one today is called SPDRs. SPDRS. Now, a good way to look at ETFs are a tradable version of mutual funds. So this came about later on in the industry. People didn't like the fact that they couldn't necessarily get out of a mutual fund as quickly as they'd like to. Let's say some huge news event dropped about your company that's a massive holder in the underlying mutual fund. Well, that could negatively affect the price, and some people would like to get out of the market right then and there. That is not possible because mutual funds, say it for me, are redeemed in a way known as forward pricing at the next computed net asset value. However, exchange-traded funds, or ETFs, are open-end funds, although they trade in the secondary market, allowing you to sell your fund to somebody else, not using forward pricing, although they're very similar to mutual funds. That's why I say they're basically a tradable version of mutual funds. So it's classified as an open-end fund. Legally, you can buy shares continuously from the fund's portfolio, and it trades like a closed-end fund or a stock in the secondary market, so it trades over an exchange. Most of our exchange-traded funds are passively managed index funds. The most popular one today is called SPDRS, SPDRS. So today, we've spent some time reviewing our different types of funds. We looked briefly at equity funds, our income funds, money market funds, blended funds, foreign funds, and exchange-traded funds. That concludes our session on types of funds. I'm Colin Kleck. It's time now that you go over to millionairesintraining.com and practice with our testing simulators. Thank you for watching our video, and I'll see you in the next chapter.